That's what I'm saying.
You
Like, I
love
don't.
you love your equal weight ETFs. You can pick them out pretty easily.
A bad joke
For
from the last time you picked
equal
your
weight
equal
tech.
weight tech. First time we ever,
Guess the
first time we ever do a mystery chart, and you're like equal weight tech.
I couldn't guess the
And we even talked about it before. You're like, all right,
keep it pretty. Hey, I talk
I'll
about
keep it
everyone's.
pretty general. You'll know what it is.
I was just
I'm thinking ag, and you're like equal weight tech.
I was just testing you to see how much you listened during the rundown.
Clearly not enough.
Hello, everyone, and welcome to the Nasdaq Dorsey Wright podcast for the week ending on December 15th. My name's Ian. Will, good to be back across the table here from you.
Likewise.
It is we're halfway through the last month of the year. It's kind of hard to believe.
I
right?
know. It's going quick.
It is. It's
So is
not
the market.
as quick as the markets.
Yeah.
Both had the same pun in
Uh-huh.
there you go. We have seen quite the move for domestic equities over the past couple of days. Really just yesterday, and then we saw some of the indicators kind of flip back positive with movement earlier this week, indicating more strength for domestic equities. Had some dovish commentary from the Fed yesterday after they didn't change rates again, right?
Mhm.
Kind of held everything steady. And markets seem to love it and took
Yeah.
off a lot higher. Seen a little bit of kind of a pullback from some highs. Thursday morning, we're recording this Thursday afternoon. A little bit of a pullback now, but not nearly enough. I mean, we're about flat on the day, almost for the S&P, but pretty good looking charts. A lot.
Yeah, there are some pretty crazy looking charts. We'll definitely highlight some of those. But I was thinking, so S&P last week, it was its sixth consecutive positive week, which is pretty rare. I think there's like 44 other times in history that that's happened.
Right.
So unless something tragic happens, we're gonna have our seventh consecutive positive week.
I mean, we're up what 3 or 4% on the week.
Yes, probably something. Yeah, probably something like that.
3.47 trailing week.
Yeah. Okay. So very likely that we hit a seventh consecutive positive week. Yeah, which is super rare. I don't have the stat in mind, but just know that that's pretty rare. Surprisingly, when I was looking at the data, the more consecutive positive weeks you have, the better markets did like 3 to 6 months out.
I think that makes sense, right? And that makes some of the indicators we're seeing too. I mean, it's just breadth thrust. You're just seeing more names doing well. I mean, we're looking at that NYC high-low indicator.
Oh, yeah.
Doug was talking about it earlier.
Yeah.
98% intraday.
You want to
reading.
explain like what that is?
Yeah, so the indicator is just looking at the number of stocks in the New York Stock Exchange making a new 52-week high relative to stocks making any extreme, basically. Like how many names are making a new high relative to stocks hitting a high or a low.
Yep.
98%. I mean, everything's almost hitting new 52-week highs recently, which is just a astounding number.
Yeah.
But it makes sense when we're kind of thinking about it, right? So Apple hit a new high yesterday. Microsoft's been bouncing around on highs for a little while now. These other names that are not Apple and Microsoft are not the Mag 7,
right?
Catching up.
Yeah.
Right?
Yeah. I think there is a lot of catch-up trade going on. We talked about even today, like despite the pullback, you're still seeing small caps up like 2%. Equal weight S&P is still handily outperforming the cap weight today. So I think all that speaks to widening participation, the catch-up trade in a lot of those areas.
Yeah. I mean, but just looking at the S&P chart, right? We are now at
It looks ridiculous.
30 X's in a single column is very, very rare. It is a pretty wild looking chart to have the entire trading band in one column.
It looks ridiculous.
It does, but in a good way, I would say.
If you own it, yeah.
Heck yeah. It's 110% intraday overbought reading. Might change a little bit heading into the close as we start pulling back slightly. That is very high historically. It's not typical that we see the S&P get north of 100. It's pretty rare. I mean, you got to go back to August 2020 that we were that overbought on an end of week basis.
Yeah. And I was mentioning this to you before we started recording. We should have just kept the first 10 minutes, but we were talking about how so last time the SP was this overbought on that 10-week trading band, like you said, was August of 20. And interestingly, it was right up against its all-time highs at the time in February of 20.
Just that recovery coming up.
Yeah, that like really robust recovery coming off the COVID low. You were matching the February 20 highs. So similar picture because we're not far off S&P all-time highs right now. So it's a really, I mean, of course, I think a very different market environment, but similar type of thrust off of a low to retest all-time highs.
Right. Yeah. We got the Dow hit a new high.
I don't think anyone would have expected the Dow to be the first of the major.
So, we were looking at that. It was the last one to hit a high. it fell the least, so it had the least amount
Yeah.
of work
Yeah.
to move back up, right? But I mean, yeah, like you said, we saw that. So back in August of 2020, you saw that big rally up. You're 22x's, so not 30. So, but
But who's
still
counting?
a
Yeah.
big column of X's up, hit new highs, and then we got about a 5% pullback over the next month or so.
That was
Right?
August of 20, right?
That was
Post-August of
well, the
20.
September and October of 20
Yeah.
was the pullback, and then the last few like 6 weeks of the year obviously did quite well. Obviously we have not quite as much time to have a strong finish of the year here, but it wouldn't be unrealistic to expect some kind of like we're not going to stay 100% overbought forever.
Yeah.
Wouldn't have thought we maybe would have continued to be this overbought.
We didn't think we are going to be here this long because
Right.
I know we talked about podcasts like a couple weeks ago.
Right.
I've been talking like morning videos, just the need for normalization for the market. And it's all related, equities, fixed income, commodities, but things can stay elevated longer than we expect. The whole like markets can remain irrational longer than you can remain solvent has been like super true the past 3 weeks, I'd say.
Yeah, absolutely. And when you're looking at things, when you're looking at a chart like this,
Yeah.
you want it to pull back. I mean,
Yeah.
you want it to see because that's when you get support levels. That's when you get that kind of consistent improvement.
Yeah.
That's when you get your indicator changes and improvement and stuff like that.
Yeah.
So it's good to see the breadth thrust improving. You want it, you want to see some kind of pullback or normalization just for healthy markets. It's a good sign. Right?
Yeah.
I mean, if we got a 5% pullback, that would put us just beneath that like 4,500 level right now. Which is a big column of those down, but not nearly as big as the column of X's up that we've seen. So that whole idea of higher lows is kind of what we want to look for moving forward.
Yeah, and you mentioned some of the indicators. So you mentioned like the high low being high, for lack of better words.
Yeah.
Then you have the 10-week, which is measuring how many stocks in the S&P 500 are above their 50-day moving average. That looks like we're going to cross 90% after action
Which
today.
is classic breadth thrust.
Yeah, we just classic breadth thrust. We put some pieces in the report about it. I'll see if I can dig up an image on it later, but typically, what is it? Returns are good, longer horizon, consolidation in the short term type of story.
Yeah. Yeah. I mean, you're looking at it as that indicator tends to go to extremes, right? So it gets very high and then it gets low because it's a more near-term focused indicator. Another one looking at the weekly distribution for the S&P. So the average overbought oversold reading of the constituents underneath the hood of the S&P.
Equally weighted.
Equally weighted, right?
Yeah.
We just hit 58% with movement yesterday. Interestingly enough, the last time we hit 58% was in June of 2020. So in June of 2020, you saw more names rallying up, got you up to higher levels, and then the S&P kind of continued to carry up in overbought territory after that. Obviously, more volatility, wider trading bands. It took more work to get it up into more overbought.
That's a good distinction.
Yeah, because we've been in a pretty consistent market recently, so it doesn't take quite as much work to get it to overbought as it would have previously.
That's a good point because 2020, of course, there's some comparisons made. It's like the magnitude of equity moves and rebounds and so forth, but volatility was very different. Vol was much higher. The VIX just hit like a multi-year low earlier this week. It's like low, like pre-COVID lows.
Yeah,
like 2017 lows when the market, like people were guessing if you like gained 2 basis points a day type thing. So yeah, that's a really good distinction. Just a difference in vol makes.
It's going to change that trading band, right? Because right now you see the top, the mid, and the bottom of the trading band. It's functions around how the last week's moving average relates to the I think 5 weeks ago moving average. So if you get wider moving average swings, you're going to get a wider trading band. Right now, it looks big on the chart, but just something else to kind of keep in mind. But nonetheless, you tend to see that weekly distribution chart again get up around the 58-60 level. It doesn't tend to move all that much higher from there. It tends to pull back, but with a lot of these, I mean, you want to see that kind of movement, right?
Yeah, I think a lot of people want to see that because sentiment follows price. So I think people have become more bullish as the market starts to advance higher. So I think a lot of people are looking for that opportunity to get back in, to put money to work. I think year end will be interesting too because there's always some big rebalancing going on.
Right.
So we'll see how all that shakes out because I think some bond funds have actually done better than some equity funds this year just because rates have come down so quickly that bond funds have rallied. So I would expect some big rebalancing.
Yeah, I think so you look at those near-term indicators, which are frothy levels, right?
Yeah.
The PTSPX is only at 60%.
Which is great.
PTSPX, percentage of stocks in a positive trend on their default chart from the S&P. Generally, we like to see it above 50. I mean, you go back to prior highs. We saw it in July. It topped out at 74. In February, it topped out at 74
Of this year.
of this year.
Yeah.
When you go back to 2021, you got to go up, we got up to 92% in April of 21. So it's usually, when you get into these frothy environments, that indicator is usually quite a bit higher.
Mhm.
Which is, we'd like to see some more longer term strength develop from these names that
Yeah.
haven't led the pack, right? But there's room for it to move,
Mhm.
room for it to continue to move at least.
Yeah, I think our data will show with that positive trend indicator for the S&P. If you have at least 60% of stocks in a positive trend, that's kind of your healthy line of demarcation. Yeah,
And we
50.
just hit it yesterday.
Yeah, like typically 50, like that's a good conversational
Right.
threshold, but like data shows, I think like really around 60% is where most market environments look healthy. And you can eyeball that on the chart too and see that most markets hang out in that
Right.
60 to 85, 90 range.
Yeah. I mean, there's two ways to look at that. It's like, hey, we have overbought levels on the near term. We haven't gotten quite as high on the longer term. If we turn back around, that's quicker to fall
Yeah,
lower, right? Or you could look at it as we have more room for this indicator to move higher from a longer term, right?
think
I mean,
that's the
and
point,
when you
yeah.
think about it on a point and figure chart, the more consolidation you get sideways, the easier it is for something to move back into a positive trend because that trend line is going to come down. And so that could be something else that we could kind of see continue to develop. Get a little bit of consolidation, some normalization. All of a sudden, these trend lines are not going to be quite as far away as they were before. Could see further positive development lead to quicker changes higher.
Yeah, yeah. And with the expansion and breadth, so many stocks doing well, a ton of what I would call like technical upgrades. So stocks increasing in attribute rating on our system, going back into positive trends. It gives more opportunity for active management where there's more things to buy apart from just the cap weight S&P. You know, people were like forced into beta for 2021 and even a lot of 2023. But now when you're seeing this expansion, it gives more opportunity to add value.
Yeah, like you were saying, the RSP is still positive on
the day.
On the day.
Yeah.
Just what were you saying? It was up year to date.
RSP.
Yeah.
I don't know. It was like 10% now or
I mean,
something like that.
it's got room for these other areas to continue to improve. You see the same thing in small caps, right? I mean, we're talking about small caps. The default chart for IWM just hit a new 52-week high today, broke that 200 level for the first time since August of 2022. Very weak, kind of longer term fund score, but it's good to see where small caps are up almost 15% over the past 30 days.
Month, yeah.
That's a big move.
Yeah.
Right.
Yeah.
And so seeing those areas, I mean, that's a wide but definitive trading band that you see that kind of has continued to top out at that 200 level for IWM.
Yeah.
If we can get some maybe consolidation and further follow through higher,
that would look good.
It would.
Yeah, that would look really good for me. I think that is a concern. I was talking to a lot of people today, actually. We've been pretty busy on calls and emails asking about names, but a lot of those names have like ran up to the top of these trading bands and these trading ranges that they've been in are like really overbought at current levels. So you'd really like to see some consolidation, some demand hold them at this level,
right,
and not just drop right back down.
Right.
So yeah, I think consolidation at current levels, some higher bottoms, like building out of these trading ranges would look really good.
Yeah, technical strengthening, more support. I mean, that's at the end of the day, that's ideal. For forward improvement.
Yeah. So I know we talked a bunch about equities. I was going to mention, so to just pivot, bond fund, AGG, most overbought since the March 20 bottom. So just speaking to how like quickly rates have come down, of course, the Fed meeting yesterday, not so much the decision, but like you said, I think the commentary after is what drove a lot of the market action, or just really catalyzed the trend that's been in place for the past month and a half or
Which
so.
is a little surprising because you kind of came into it. I think all the talk beforehand was people expecting more hawkish posture.
We thought it was
given
talk
the
it down.
10% improvement we've seen in equity since their last comments, and then and so I think coming in, but like you said with AGG, that's a you covered up the name of that chart a couple weeks ago, and I did not get that was AGG, right? It's not a bad looking chart. Seeing it move back to that positive trend. You got 3 consecutive buy signals now. It's very overbought. You're also, that's a pretty noticeable resistance point up around that 100 level.
Yeah, I mentioned that on the morning video today.
You're a buck away from that now.
Yeah, a buck away. Yeah, but that $100 range or $100 resistance point will be notable.
Yeah.
And you mentioned earlier, like TNX 10-year yield broke back into a negative trend.
Right.
I think that's been a pretty big development. I believe the 30-year yield, so TYX, as of today, is going to also break back into a negative trend, which is great for bond funds because yields go down, prices go up.
Right.
But I would say this is another tangent, just thinking like, why are expectations for rates coming down? Why are rates falling? Typically, economy needs more support. Monetary policy needs to be more accommodative for demand concerns. So I think there are some concerns worth mentioning and thinking about as an investor, as an advisor. Why are rates coming down? Not just like, oh, all my positions are up 10% this month.
It's nice to draw on that for a little bit though.
It is nice to draw on that for a little bit, and I'll just park there for now.
Yeah, no, I think that when you're looking at that TNX chart, right, you got two consecutive sell signals drop down. It's AGG is very overbought, TNX is very oversold.
Yeah.
And the next support level we see is down to that 37.50. You got kind of steady support from there over the next like 36.50 are going to be support there for that TNX chart. So we've seen overbought become more overbought for equities. We've seen oversold become more oversold for yields here. I would imagine if we got normalization in one, it's going to lead to more normalization in the other, right?
Yeah.
Like you were talking about for other assets, before jumping on this, like crude oil is pretty oversold.
Yeah,
right?
yeah.
And you had that like crude oil gold relationship that you were touching on.
Yeah.
It's with things are at extremes on both ends.
Yeah.
Right? You probably, when that happens, gonna see they're not gonna stay at those extremes forever.
Right. Yeah, I mean, that's a good point you make, because the markets are a web. Things are connected. If you move one piece, it's going to affect a lot of other pieces. So you mentioned equity super overbought, yield really oversold. Normalization for one or the other would be kind of congruent, go together. And same thing with the commodity space. Commodities have been pretty oversold. Crude oil, I think, being a big one. I was looking at the relationship that you brought up, crude oil and gold. I mentioned it in alts yesterday. It's a bit of an odd relationship to look at, but that's at a really like multi-year relative strength low, which tells us that crude oil has been materially underperforming gold. And I think that helped the latest inflation report because, of course, crude oil, whether explicitly or implicitly, factors in to prices.
Right.
And if you do get a rebound from crude oil, which looks possible compared to gold, its economic implications aren't that big. That could put some, at least super not that clear. Yeah. So that could put some upward pressure on prices for sure. But I think, again, just the story of normalization and the need for normalization, commodities, fixed income, equities, domestic and international, US dollar, all of that, I think is going to make things a bit more clear.
Yeah.
But for now, it looks like heavy probability of normalization across all those time frames.
Yeah, and you mentioned, Joe, I mean, we're just going to keep throwing different asset classes out here at this point, the longer we stay on the pod.
Yeah.
But you mentioned two international equities, and we saw that move in Dolly this week. International dropped in the second position, domestic equities now up in the first position. Commodities now falling down in the third position. A lot of that rotation has just been the weakness in commodities, not necessarily weakness in international. And we haven't seen international hang around quite as much because of China, frankly.
Yeah.
It just has seen weakness there that allowed domestic equities to move higher. But there are a lot of other international areas that have shown more improvement, like European financials. I was looking at that. Like Europe looks pretty strong.
Thank goodness you didn't put that on the chart
I
last
thought
week.
about it. EUFN, it was the ticker I was looking at there. That just broke out to a new 52-week high from some notable resistance. It's also in overbought territory. Very similar kind of technical pictures to a lot of what we're seeing here. So it's not just the U.S. stocks that are having some of the same kind of move.
Yeah, and not to get too granular, as we're probably about to finish the pod, but talking like financials, like sector-wise, even domestically, we were talking about this on our research call the other day, where you would think interest rates going up are typically more favorable for financials like big banks via the lend on the long end, deposit, et cetera. But you've seen rates coming down and banks behave really well, maybe because of the bonds that they hold in their accounts are not as underwater as they were before. So I think there's a real tailwind there. It's been some of the most improved sectors that we've seen on Dolly, on our asset class group scores page. Another rate sensitive sector that I mention every week on our rundown to real estate. Over the past 30 days, the sector's up like 15%. It's up another 2 today.
Still ranked last.
Still ranked last. It hasn't climbed out of the basement on any rankings. Like Dolly group scores, no matter how you look at it, that sector is
it has
still,
a ways to climb.
It has a long ways to go.
And that's just nature of some of those relative strength relationships, right?
Yeah.
You see such a big column of those down, you need a massive column of X's up to change some of those charts.
Yeah. And it's
working there.
yeah, and it's very probable when things get beat up, they become more volatile. So you typically see some more violent moves off the bottom relative to something else.
Right.
So
But
you
when-
just mentioned like rate sensitive sectors are behaving as you would think.
And you think about some of that too. If we get talk about normalization, things kind of snap back a little bit.
Mhm.
You expect those also to maybe snap back in the other directions. All of a sudden, you get to calm those down. That buy signal is a lot closer than it
Yep.
used to be
Yep.
if you get those changes. So you want that kind of consistent movement. You don't want these sharp moves to continue forever.
Yeah.
Across the whole space, right?
Yeah.
That's when you get the consistency is what leads to helpful relative strength changes, right?
Yeah,
Over time.
And especially from our point of view as trend followers and a momentum shop, you need that consistency of
You need the
signals.
confirmation.
Yeah, you need the confirmation, you need consistent signals. These whole like elevator moves are really rough for trend following. So
Yeah.
if we can stay away from those, if we get a healthy pullback and a continuation of leadership, the laggards don't, completely flip the market on their head, then I think it could be a pretty good case for trend following.
Yeah, for 2024. Or the market can just keep going up forever. That'd be cool too. But,
Yeah, that's fine.
all right, 40 column,
People can
40 X's in a column.
Yeah,
Come on, we
people
can do
can scream at it all they want and they can hate the market for a million reasons, but the market's going to do what it wants to do. Being bearish should always sound super smart in the
Right.
moment, but like I said before, markets are going to do what they want to do.
Yeah. We can probably leave on that for this week.
Period. Yeah.
Mic drop. But yeah, I guess with that, Will, it's good to be back here talking with you. I think we got at least another podcast or two. Maybe it won't be we got another couple more for the year that we can round up with some favorite charts or something to look at maybe
Yeah.
down the road. So
Yeah, like charts of 2023 or something like
yeah, it'll be a lot. It'll be longer than this.
that. All right. I like it.
Cool. Well, yeah, with that, thanks everyone for tuning in this week as well. And we'll look forward to talking with you again next week.